So hello guys, in a previous video, I explained you what is the meaning of the DCF valuation. But in a today's video, I walk you through a complete basic discounting cash flow model, which I build in an Excel step by step. So this model helps you to understand or find the intrinsic value of a company based on its future cash flows. So watch the video till the end.
So let's begin with the key assumptions used in this DCF model. On the left hand side, I take the 5 important assumptions. First is the growth rate is 1.7%, which reflect a conservative long-term growth expectation. Second is EV upon EBITDA exit multiples. Use is 7x, aligned with the mature industry standards. Third is cost of debt is assumed at 5% and corporate tax rate is 25%. Fifth important assumption for calculate the cost of equity is risk-free rate represented by the government treasury yield is 1.5%. The right hand side, the beta is 1.3, indicates the stock is slightly more volatile than the market. Second is expected market return is 10%. This assumption are critical because they are directly affect the discount rate and the terminal values. Now go to the second section. Now let's move to the core DCF. Free cash flow to the firm and or FCF. Step 1, EBIT projection. EBIT grows from 5,000 in year 1 to 5,800 in year 5. It's slightly steadily and realistic operating growth. Step 2, taxes. We calculate the taxes, but we moving forward to depreciation and amortization. The depreciation and amortization is add back since it is a non-cash line, non-cash expenses. Fourth step is capital expenditure. Capex is deducted because it represent actually the cash flows. The annual capex is assumed at approximate 1,500 to 1,550, showing reinvestment in the business growth. Step 5, changes in working capital. Changes in working capital are the negative, meaning the cash outflows but gradually reducing over the time. This indicates improving the operational efficiency. So now we calculate the tax rate. So how we can calculate the tax rate is equal to EBIT into minus 25%, which is the tax rate. So now firstly you have to freeze the tax rate. So you have to click the F2, freeze freeze the tax rate. Then you have to click F4, enter, and now you copy this number and drag from year 5, alt ESF. Okay, so now you have to calculate the free cash flow after adjusting all the components for free, and now you have to adjust all the components. So simply you have to sum, enter. Now you copy and drag this number from year 5 to year 5. So see, you get after adjusting all the components, free cash flow increase 2,345 in year 1 to 3,025 in year 5, showing a strong and improving cash generation. Now moving forward to third section, which is a WACC calculation. Next, we calculate the weighted average cost of capital, which is a discount rate used in DCF. But firstly, we have to calculate the cost of equity using the capital asset pricing model. The formula of capital asset pricing model is RFR plus beta RM minus RFR. So RFR plus beta into market returns, which is 10% minus risk-free rate. Enter. So the cost of equity is 12.5%. Now you have to calculate the weight of debt and equity debt in the capital structure. Is equal to debt value, which is 15,000, divided by sum of equity value plus debt value. So is 46.2% of debt weight in a capital structure. Now you have to calculate the equity weight in the capital structure. Easily you have to how you can easily calculate, you just have to do 1 minus debt structure, so you can get 53.8%. now you have to calculate the weighted average cost of capital. The formula of weighted average cost of capital is weight of equity into cost of equity plus weight of debt into cost of debt 1 minus tax rate. So weight of equity into cost of equity plus weight of debt into cost of debt into 1 minus tax rate. So after combining cost of equity and after tax cost of debt, the WACC comes out approximate 8.5%. This rate reflects the company overall risk profile and the capital structure. So moving forward, now comes to the terminal value. Firstly, we have to calculate the EBITDA. So we don't have given the EBITDA value, so we calculate this EBITDA value to EBIT plus depreciation and amortization. So the final year EBIT plus depreciation and amortization. So we get 6,120 as an EBITDA value. Moving to the exit multiples. So how we can calculate the exit multiples is a very simple formula, is EBITDA into exit multiples, which is given the 7x, the industry standards. So we get 42,840 as an exit multiples, and now we have to calculate the perpetual growth rate. So the formula of perpetual growth rate is final year free cash flow plus one plus growth rate divided by required rate of return minus growth rate. So final year cash flow into 1 plus growth rate, which is 1.7%, divided by WACC minus growth rate. So we get 45,318.44. So now we take the average of exit multiples and perpetual growth rate for more conservative. Second, for average is this. So we get 44,079.22. So moving forward to discounting the cash flows. So now we discount all the future cash flows back to the today using the weighted average cost of capital. So how we can calculate it? So is equal to 1 divided by 1 plus WACC is to compound. So now we have to compound it. So go to the year 1 section and enter. Now you have to freeze the discount rate, which is WACC. So press F2. WACC is this. You have to freeze it. Then okay. Then copy and shift it from year 5 and drag this. So you get all the discounted cash flow numbers. And now you have to discount these numbers from free cash flows. This into free cash flow. To drag it from year 5, press. So now you have to calculate the present value of the terminal values. So it will get the discount rate into this number, which is average of exit multiples and perpetual growth rate. So you get the 29,330. So now you have to calculate the enterprise value. The enterprise value is basically market capitalization plus debt minus cash and cash equivalents. So you have to add all the present value of the free cash flow and the present value of the terminal value. So you get 39,839. To arrive at equity value, we adjust the enterprise value. To arrive at equity value, now we have to adjust the enterprise value at cash 500, add marketability securities which 4,500, subtract short-term debt and subtract long-term debt. So let's do this. This plus cash plus marketability securities minus short-term and long-term debt. So we get 25,339.20. Now we have to calculate the implicit share price, which is the equity value divided by number of shares outstanding. So you get 25.3392. This represents the intrinsic value of the stock based on fundamentals. To conduct this DCF valuation, show that the company generate the stable growing free cash flow supported by the reasonable assumptions and the balanced capital structure. The DCF is a long-term valuation approach, and while assumption may this model prove a strong fundamental estimate a intrinsic value. Thank you for watching. If you found this useful, feel free to like, share, and for more finance and valuation content. Thank you.